A second Donald Trump presidency would significantly impact global financial markets through policies related to taxation, deregulation, monetary policy, trade wars, and foreign relations. This analysis incorporating macroeconomic factors, sector-by-sector impacts, international financial effects, and investment strategies. 1. Macroeconomic overview. Broad market trends. Under Trump, a Trump presidency would likely be pro-business, protectionist, and deregulation-focused, creating a short-term stock market rally but long-term economic and geopolitical uncertainties. Key policies expected to shape financial markets. 1. Taxation and fiscal policy. Lower corporate taxes similar to the 2017 Tax Cuts and Jobs Act could increase corporate earnings and boost stock valuations. Possible tax cuts for high-income earners and businesses would increase capital investment in U.S. companies. Deficit concerns. Trump's tax policies would likely widen the budget deficit, leading to higher U.S. debt and potential credit downgrades. 2. Interest rates and monetary policy. Trump has historically pressured the Federal Reserve for lower interest rates, which could lead to short-term stock market gains as borrowing becomes cheaper. Weakened U.S. dollar, USD, making exports more competitive but raising inflation risks. If inflation rises, the Federal Reserve may be forced to tighten monetary policy, increasing market volatility. 3. Trade wars and tariffs. Likely escalation of U.S.-China trade tensions potentially imposing. Higher tariffs on Chinese goods, disrupting supply chains and increasing consumer prices. Retaliatory tariffs from China, affecting U.S. agriculture, tech, and manufacturing. Trade disputes with Europe, Germany, France could trigger higher tariffs on cars, steel, and luxury goods. 4th, deregulation and industry. Specific policies. Energy. Deregulation of oil, gas, and coal industries, reducing restrictions on fossil fuel production. Technology. Possible antitrust actions against big tech firms, Amazon, Google, Meta. Finance. Reduced banking regulations could allow higher leverage and profitability for financial institutions. 2. Impact on financial markets. A. U.S. stock market analysis. A Trump presidency would likely create sector-specific booms and busts, causing shifts in investment strategies. Bullish sectors. Winners. 1. Big tech. Apple, Microsoft, Meta, Google, Amazon. Lower taxes equals higher profits. AI and automation growth equals more investment in high-tech R&D. Risk. Possible antitrust measures targeting monopolistic behavior. 2. Energy. ExxonMobil, Chevron, Halliburton, BP. Trump's policies favor oil and gas production, increasing global crude supply. Potential rollback of environmental regulations equals lower costs for energy firms. Impact. Renewables may struggle, but traditional energy sees higher profitability. 3. Defense and aerospace. Lockheed Martin, Boeing, Northrop Grumman, Raytheon. Increased military spending could boost U.S. defense contractors. Geopolitical tensions, Russia, China, Iran, equals more demand for defense exports. 4th, financials, J.P. Morgan, Goldman Sachs, Wells Fargo. Deregulation, lower capital requirements, increased lending margins. Higher Treasury yields boost bank profitability on loans. 5. Infrastructure and construction, Caterpillar, Vulcan Materials, Deere & Co. Increased infrastructure spending, roads, bridges, airports, could drive demand for heavy equipment and materials. Bearish sectors, losers. 1. Renewable energy, Tesla, First Solar, Enphase. Less government subsidies for solar, wind, and electric vehicles. Increased oil and gas drilling equals less incentive for renewable investments. 2. Healthcare, United Health, Pfizer, Moderna. Potential Medicare and Medicaid spending cuts could hurt hospitals and insurers. Drug pricing deregulation may favor big pharma, but overall sector uncertainty remains. 3. Consumer goods and retail. Walmart, Target, Nike. Higher tariffs on Chinese imports increase costs for U.S. retailers. Possible consumer spending decline due to inflationary pressures. 4th. Automotive industry. Ford, General Motors, Tesla, BMW, Volkswagen. Tariffs on imported auto parts increase car prices, reducing consumer demand. Electric vehicle incentives might be cut, hurting Tesla and EV manufacturers. B. U.S. bond market. Short-term impact. Lower interest rates. Bond prices rise, bullish for treasuries. Long-term impact. Higher deficits. Treasury yields rise, reducing bond attractiveness. Junk bonds. Deregulation allows riskier corporate lending, making high-yield bonds volatile. C. Foreign exchange and currency markets. Weaker USD in short term. Rate cuts plus trade war concerns equals lower dollar value. Emerging market currency risk. Countries dependent on U.S. trade, Mexico, India, China, could experience currency depreciation. Stronger Japanese yen, JPY, and Swiss franc, CHF, as safe haven currencies. 3. Global market impact A. China and emerging markets. Renewed U.S.-China trade war could cause global market turbulence. Supply chain disruptions impact manufacturing-heavy economies, Taiwan, Vietnam, Mexico. B. European markets. Possible tariffs on EU autos and steel would hurt German and French companies. Strong U.S. dollar could weaken European exports. Commodity markets, oil, gold, industrial metals. Oil prices. Pro-energy policies equals higher crude oil production, but geopolitical tensions could drive oil price volatility. Gold. Inflation fears and market uncertainty. Higher gold prices, bullish for precious metals. Industrial metals. Copper, aluminum. Higher tariffs on China impact global commodity demand. 4. Risks and market volatility. Fiscal deficit risk. Tax cuts plus spending equals ballooning debt, increasing risk of a credit downgrade. Trade war risk. Tariffs on China, EU, and Mexico could slow global economic growth. Inflation versus recession. Risk. Tax cuts boost GDP, but inflation could force the Fed to tighten monetary policy. 5. Investment strategy recommendations, bullish investment strategies. 1. U.S. stocks in energy, defense, financials. 2. Short-term bonds, 1 to 3 year treasuries, for yield stability. 3. Oil ETFs and commodities, XLE USO, for energy gains. Defensive and hedge strategies. 1. Gold ETFs GLDGDX as a hedge against inflation. 2. Short emerging markets. ETFs, EEM, FXI, to hedge trade war risks. 3rd. Put options on S&P 500 for volatility protection. Final conclusion. What Trump's presidency means for investors. Short-term rally in stocks. Energy, defense, financials, due to pro-business policies. Long-term risks from fiscal deficits, trade wars, inflation, and geopolitical tensions. Investment strategy. Stay sector-specific, hedge volatility, and monitor bond markets carefully.